working with Denise for almost 10 years. And in the pre-COVID days, she would often be kind enough to offer me a ride home, saving me from what she referred to as the soul-sucking commute. And in those car rides, we would cover a myriad of topics, all while having a lot of good laughs. Because you see, in addition to being very smart, my friend Denise has a wicked sense of humor, and all the better to cover a dense topic such as ours that we're going to cover tonight. So just a few highlights on her background. She is our Senior Vice President and Senior Fiduciary Officer for Northern Trust in Northern California. She has also, prior to her career at Northern, she practiced law, specializing in tax, estate, and charitable planning, estate and trust administration, and tax controversy, most recently at Orrick, Harrington, and Sutcliffe. She also headed the Northern California fiduciary practice at U.S. Trust and served as a Chief Fiduciary Officer at Morgan Stanley. Denise has a BS in accounting, a JD from the University of Iowa, and a Master's of Laws in taxation from Golden Gate University, all with honors, of course. Why not? So Denise has lived in the Bay Area for 20 years, currently resides in Marin County with her husband, her daughter, and her twin sons. She's an avid mountain bike rider, a novice sailor, and a huge, huge animal lover. So with that, I give you the fabulous Denise Riley.
Thank you, Kate. Can you hear me?
Loud and clear.
Okay, well, that was a very generous intro. And the one thing you forgot in there is I'm terrified of technology.
But you're doing great.
So I'm terrified of technology, and you didn't tell me I had to follow the owl. So I'm feeling a little bit behind.
That is hard
here. I know that's no good. That is no good.
And I mentioned one thing that I forgot, and I apologize terribly, which is everybody, we'll get through the presentation and then we'll have a Q&A session. And I'll have you do that on chat because it's probably a little simpler than people just shouting out things. But you know, if you don't know how to use the chat, go ahead and shout it out. But we'll try for the chat. So excuse the interruption.
Okay, all right, so we'll get started here. I'm going to try to limit things to 30 minutes because I'm mindful of keeping everybody awake. So let's get started. I wanted to start out just by answering a question which I think people often have, which is my giving making any kind of a difference? Like what am I doing? What's the overall impact here? And oops, I'm going the wrong direction. And the answer to that is a resounding yes. It really does make a difference. So I pulled some figures from 2019, which were the most recent that I could find. And in the year 2019, about $450 billion was donated to charities, which is, that's more than a nominal amount of money. And you can see here on this circle chart, the vast bulk of that, almost 70% or almost $310 billion was gifts from individuals, which I think is just a stunning achievement, really, and such a powerful thing. And that's followed by foundations here in this sort of yellowy box, bequests or gifts at death, and corporations who make up 5% of the giving. And a couple of little things I pulled out of this that I thought were interesting. The years 2017 through 19 represented the highest 3 years of giving on record, which was a figure that made me kind of happy. And I suspect that when we get 2020 numbers, that will be the case in 2022. And the other thing that I think would make all of us on this call happy is that giving to environmental and animal organizations has increased 11.3% over the prior year, which is the 6th consecutive year of growth in that category. So that makes me happy, and I assume it makes everyone on the call happy. Mother Nature is doing okay in this category, and I think she can use all of our help. So that's kind of setting the stage here for what we're doing when we're talking about charitable gifting and why we're doing it. And just keep in mind, it does make a big impact. So I want to talk today about, I want to kind of give you the landscape of charitable gifting because there's a lot more going on and a lot more ways to give than writing a check or volunteering your time. And there are a lot of different techniques that can be used. And I'm going to go over some of the more popular ones this evening and just give you an idea of what those are and when they might be used, because it's a little bit like a toolbox. You use a hammer to pound the nail, you use the screwdriver to screw in the screw. So you have to figure out what you're trying to accomplish, what problem you're trying to solve before you can figure out which is the right tool for you. And when you're thinking about different ways to give, here are some of the things that you want to think about. What are the assets you want to contribute? People have a lot of other things other than cash that can be used for charitable gifts, and they can benefit both the charity and the individual donor. So, what's on your asset list that you can part with or want to part with? For more complicated assets, you have to think about whether the donee organization, whether the charity can take in those assets. So cash is pretty simple. I think everybody agrees that they'll take cash. But you can also gift things like real estate, limited partnership interests, a really big topic right now, cryptocurrency. Charities are starting to think about what can they do, if anything, with cryptocurrency that people want to donate. So with the more esoteric types of asset categories, you have to figure out if you're talking to a charity that really can take in those things and has the capacity to deal with them. Do you need the asset at some time during your life, or do you need an income stream from that asset? There are ways to make a gift where you can part with the asset itself and keep an income stream from it for your lifetime, which really can benefit both you and the charity. Do you want to be recognized for your gift? Are you the kind of person that wants recognition for your gift, or do you want to make it private? And that's something that's really important to talk to the charity about, I think. What's your time frame for the gift? Are you trying to really get the biggest possible tax deduction that you can? If so, there's nothing wrong with that, but you have to make sure that you understand what your options are and how to make that happen. And then with the more complicated strategies, those have legal tax implications. They need to be set up the appropriate way. So you really do need a team of people around you who understand how to do that. And I think part of that thinking is, does the complication of both the strategy itself and the professionals that you need to help you with it, is it worth really what you're trying to accomplish? And maybe it is, maybe it isn't. So those are some things to keep in mind. Now let's move to what I'm talking about, charitable gifting vehicles. Really, what are we talking about? So this slide takes us through some of the more popular ways to make gifts. And it goes from the left here, the simpler with just lifetime direct gifts, the very simplest lifetime direct gifts of cash, over to the other end of the continuum when you're thinking about how to gift some of the more esoteric assets, like let's say limited partnership interests or cryptocurrency or coins or something like that. So I'm going to walk through these, tell you kind of what they are and when they might be used, some pros and cons to them. Direct lifetime gifts. These are really simple. You control when you make the gift, what your assets are that you're contributing. You get an income tax charitable deduction in the year you make the gift. And I want to talk for a couple of minutes about something that's happening in 2021. There's a huge tax advantage in this year alone, unless it gets extended, for people who itemize deductions. Now that's kind of a big if, because under current tax law, many more people are using the standard deduction than was the case in the past. But if you are somebody who itemizes deductions, in 2021, you can make cash gifts to public charities, and you can make that so it offsets your income all the way up to your entire adjusted gross income. Income tax deductions have limits. And the idea with that is you shouldn't be able to offset 100% of your income with a gift to charity, so that your income is zero and your tax is therefore zero. But for cash gifts in 2021, you can do just that. So that is a 1-year thing, like I said, unless it's extended for some reason. And it's very powerful this year. If you're gifting other types of assets, so for example, stock that you've held for over a year, that's long-term capital gain property, that you can take a deduction for its fair market value, but the amount of that deduction is limited to 30% of your adjusted gross income. So you get a lesser benefit potentially, but there may be reasons that you would want to gift that stock and not the cash. So those are the kinds of interesting discussions that you have with your accountant and your other financial advisors when you're trying to figure out what to give. Let's see, gifts of appreciated stock. This is kind of a simple thing, but very powerful. A lot of people have stock of, Apple or IBM or whatever, pick your favorite stock that they've had sitting around for a long time. and they bought it at a very low price, and now it's worth a lot of money. And if they were to sell the stock, they would pay capital gains tax on that stock. And so a lot of people tend not to want to do that and will hold on to the stock. So if you're of the mind that you want to make a charitable deduction, you can give cash to your charity. That's simple, that's easy. You could also sell your stock, pay your capital gains tax, and give the balance to the charity. Of course, you wouldn't be giving them as much money because you had to pay the tax. The better way to go, if you have that appreciated stock, is give the stock itself to the charity. So let's say you take your Apple or your Amazon stock and you give those shares of stock to WildCare, and they're worth $1,000 a share, and you bought it at basically zero. So if you were to sell it, you would be paying tax on that $1,000 gain per share. But if WildCare turns around and sells the stock, they pay no capital gains tax because WildCare is a tax exempt entity. So the benefit of doing that is WildCare gets the full $1,000. There's no tax paid, and you get the income tax deduction for the $1,000 of stock that you gave to WildCare. So it's kind of a win-win for everybody. And again, it's a really simple thing to do. So if that's you, and you have that stock that's been sitting around, that it's always worthwhile thinking about whether it's worth, whether it makes more sense to give that kind of stock or to give cash. The next thing I want to talk about here are IRA charitable rollovers. So if you have an IRA, and this applies to IRAs, not other forms of retirement accounts like a 401k or a 403b plan. This is an individual retirement account benefit. So with IRAs, once you reach age 72, you have to take a certain amount of money out of that IRA every year. And the idea is the account is depleted over your life expectancy. And the amount of money you take out every year is called the required minimum distribution. So there is a really neat trick in the tax law, which allows you to satisfy that minimum distribution that you have to take out every year by giving that amount to a charity rather than taking it yourself. And this can work out really nicely for people who don't need that minimum distribution. And sometimes we find ourselves in that case because as IRAs built up over time and you either don't want to take out the entire amount that you're required to for that year, or for whatever reason that year, you just don't need it. And the problem with taking it out of the IRA if you don't need it is you pay income tax on it. So that there's this really cool benefit in the law that allows you to transfer directly from your IRA account to your public charity like WildCare up to $100,000 per year. And it's really slick. It's very easy to do. Money goes directly from the retirement account to the charity. The distribution amount is deemed to be satisfied. And on your income tax return, that distribution that went to WildCare doesn't even show up as income. So there's no income tax on it. It's great. It's a really nice technique that we see people using all the time. The disadvantage to this, obviously, if you're giving the distribution to charity, you don't have it for yourself. So you wouldn't want to do it unless you really don't need it. And this is only something that can be gifted to public charities. It's not available to private foundations or other types of charitable organizations. But it's a really good thing. And that's been in the law for the last number of years, and it keeps getting extended. So I'm not sure at this point whether it's a permanent fixture, but hopefully it will be. Other retirement plans. Now we're moving into things that are slightly more complicated, but not terribly complicated. And these are ways to make gifts to charities at death. So anything with a beneficiary designation, a retirement plan, this would apply to a 401k, an IRA, life insurance policies, anything with that beneficiary designation form you have to fill out. That beneficiary designation is essentially a contract that says what happens to the money in that account when you die. It's not an asset that goes through your regular will or your living trust or your estate plan as such. It's kind of separate and apart from that, which makes it really easy to gift that kind of asset. So if you want to use retirement plan assets to gift to charity, there are advantages to doing that. The way you do that is very simple, just by naming the charity on your beneficiary designation. It's easy. You can change it anytime you want to before you die. and you can split it. So when you fill out your beneficiary designation form, you don't have to name just a single beneficiary. You can name, my daughter, my son, my cousin, and WildCare, all in equal shares. So it's very easy to make gifts of this type of asset to different beneficiaries. Why would you give retirement assets to a charity? And the reason is because when retirement assets pass to a person after death, you pay income tax on that distribution. So for people with taxable estates, which granted are not a lot of people anymore, it's a terrible result, because if you have a taxable estate, the asset value is included in your estate. There's a state tax on that. And when then the money is distributed out to your beneficiaries, they pay income tax on that. So at the highest rates, the taxes take up about 80% of the retirement account. So it's a bad result for tax purposes. But even if you don't have an estate tax problem, when you distribute retirement assets to individuals, they do pay income tax on those distributions. If instead you distribute those assets to a charity like WildCare, they don't pay income tax. So if you have a situation where you want to leave a charitable gift and you want to leave gifts to other individuals, and you have this retirement account and you've got sufficient assets to leave to individuals out of other things, leaving the retirement account to the charity makes a whole lot of sense. Life insurance beneficiary designations are similar. Life insurance doesn't have that income tax problem. So when you get proceeds from a life insurance policy, you're not paying income tax on it. But you can name a charity as a beneficiary of the policy. Again, it's very easy to do, simply with the beneficiary designation. It's revocable. You can change that beneficiary designation anytime you want. So it's a very easy way to effectuate a gift. Now, one thing I want to say about beneficiary designations that I've learned over the years is that when you do a beneficiary designation for your retirement plan, a life insurance policy, whatever, you want to fill it out on the company's form. So if your assets are at Northern Trust, you want Northern Trust beneficiary designation, or Schwab, or wherever, or the life insurance company. You want to use that company's form, fill it out, particularly if it's a little bit more complicated, give it to the company, make sure they have it, they confirm to you that they have it, they understand it, and there's no questions. Because I have been in situations where the holder of the account has lost the beneficiary designation after someone has died, or there's a question that comes up in one that's more complicated, and it's really difficult to get that sorted out after the fact, after somebody's died. So it's just one of those things you learn the hard way, but you really have to be very diligent in making sure that the company has the beneficiary designation. And if you've changed it, they have the most current one, and they confirm that to you, and you keep all those records. And that is a lesson learned the hard way. So you don't want to repeat that one. Moving on in the continuum of complication would be the charitable pledge. And these are used really frequently, particularly with larger gifts. We see these a lot. And a charitable pledge is really nothing more than a promise to make a gift in the future. So sometimes these people will use these if they're making a large gift over time, so $100,000 a year for 5 years, let's say, or they want to make a gift either during life, or if it's not satisfied during life, at death. A pledge can be used. It's nice because you don't have to pay the money right then and there, but you've committed to the charity that you're going to give them a certain amount over a certain period of time so that they can count on that. It is irrevocable. Unlike the things we've talked about so far, this is irrevocable. Once it's done, it's done. So you execute the pledge agreement. You've made at that point an irrevocable gift. You can't get it back. And it is a binding contract, and it's a binding agreement with the charity. So you have to be really sure that you want to do it and you don't want to change your mind. And the charity, because it's now received this binding promise, is obligated to enforce those agreements, which, if you have a large donor to your organization who changes her mind, let's say, after making a pledge, that can lead to some awkwardness. So it's something, obviously, with any irrevocable gift, it needs to be thought through really carefully. Now, the tax implications of this are a little bit different than when you make an outright gift. You get an income tax deduction for the amount, but you don't get it when you make the pledge. That's when you commit to doing something, but you don't get the income tax deduction until the pledge is satisfied. So in other words, you get the deduction when money changes hands, not when you make the promise. So again, that's something that's worked out with your financial advisors, your accountants, to figure out the proper timing of that, to line up the deduction and when you can best use your deduction with when you want to part with funds and give the charity the money that they may need. You can use appreciated stock, like we talked about before, to satisfy your pledge and avoid the taxes you would have to pay if you sold those assets. You can use cash, you can use other assets, again, assuming the charity is equipped to take them in. And like that IRA benefit that we talked about before, you can use that up to $100,000 per year required minimum distribution out of your IRA to satisfy a pledge too. Now, we've only talked about, for tax purposes, we've talked about income taxes, but there's also gift and estate tax, which are entirely different tax regimes. So income taxes, everybody knows what that is. But when you make a gift to either an individual or a charity, you're making a transfer for gift tax purposes, or if it's on death, it's estate tax purposes. Now, most people don't have to worry too much about that because every individual has an exemption from the gift and estate tax of $11.7 million per person. So that takes care of most of us, and we don't have to worry about that. And if we're making a gift of something over and above that amount, then we have to start worrying about the gift tax. But even though no gift tax is paid, you are making a gift that if it is large enough, it might be reportable on a gift tax return. So the way the gift tax works, and the estate tax for that matter, if you're making a gift of an asset to a charity and it's over $15,000 per year or other requirements potentially, you're making a taxable gift. So what happens, let's say I give $50,000 to WildCare. I've made a taxable gift for gift tax purposes, but I have an $11.7 million exemption from gift tax, and I can assure you I've used up not all of that. So that means my $50,000 is covered by my $11.7 million exemption, and I'm not paying any tax because I get a dollar for dollar deduction for gift tax purposes for anything I give to charity. So it is possible you could find yourself in the position of having to report a gift on a gift tax return at some point if it's large enough, but you, unless you're one of the very lucky few, you're probably not going to be paying gift tax. The estate tax works the same way. It just applies at death instead of during life. So this $11.7 million exemption you have for gifts to anybody either occurs at life and at death, and it's a total exemption, not to $11.7 million. It's depending on life or death. And then if you've got a pledge that's outstanding at death, that would be paid by your estate or your revocable trust, and then the estate gets a deduction for the amount that they're paying out. So that's a benefit to the estate as well. We might as well continue talking about charitable bequests here since we started down that road a little bit. Charitable bequest is really nothing more than a charitable gift that takes place at death, and it is done through your will or your living trust. Most people in California at least have living trusts instead of wills. And if you want to leave a gift to charity at death, you can simply write that in your revocable trust that, I leave either a dollar amount, a percentage, maybe it's the lesser of a dollar amount or a percentage of my estate to WildCare or other charities. Or the other way that it can be done is I leave, these 10 gifts to these people, everything else goes to WildCare, and that would be a remainder amount going to your charity. Again, this is relatively simple. It requires an amendment of your trust to get it into the document, but that's revocable, can be undone anytime before you die. And this, I think, is an interesting point, the next point here. It provides an opportunity for discussion between you and the charity you want to benefit. And I think that's really interesting because about 85% of all planned gifts are bequests that occur at death. But in the vast majority of those cases, the charity doesn't know it's coming. there's been no discussion between the donor and the charity, which is, in my mind, kind of a missed opportunity, regardless of the amount of gift you're making. If you're going to the bother of leaving something to a charity at your death, you care about the charity, and you may have very particular ways that you would like that money to be used or not to be used, or there may be something special about that charity that you would like honored in your memory. And so I think it's a really important and good opportunity for you to talk to your charity about a bequest. And I think there's some hesitancy sometimes by people. They don't want to do that because they feel like they'll then be, asked for money all the time. And I do think most charities are sensitive to that. And most charities that I work with are sensitive not only to that, but to people, the idea that that can be changed and people aren't committing to it necessarily forever. If they change their mind, that's fine. And also they may want it to be anonymous. I see a lot of people who want anonymous gifts, or they don't want people to know this is coming at their death. So I just would encourage, if that's something that's on your mind, to have the discussion with the charity. And, if you're not comfortable talking about dollar amounts, that's okay. But just conceptually, if I were to leave a gift, if I'm in a position to leave a gift to WildCare or whatever at my death, here are the things I care about. I would really like that to go to the owl and the owl education or research or whatever it is. We talked about this a little bit before, but assets passing to charity at death they just escape the estate tax regime if that's something that is a problem for you. And at the moment, like I said, it's not a problem for very many people. The only disadvantage here really is, obviously, if you're giving the gift to a charity, you're not giving it to someone else. So you need to have sufficient wealth to be able to take care of all the people and entities you want to. And you have to do something here that's more than filling out a beneficiary designation. You have to put this in your estate plan properly. So there's a little more work involved, but not a lot. And as a former estate planning attorney, I would caution everybody that you should be looking at your estate plan regularly anyway to make sure that it's up to date, and that things are the way you want them to be if something were to happen to you. Charitable gift annuities. This is a little more of a complex animal, but it does have some benefits and it can make a lot of sense in the right circumstances. So a charitable gift annuity is a contract between you as the donor and the charity. And really what you're doing is you're transferring assets to the charity, and in return for that, you're getting an income stream or an annuity over your lifetime. And you can set this up for one or more annuitants, but let's just use the simple case of you and the charity. So like I said, it's a contract. They're easy to understand. You're gonna see what the percentage annuity you're going to get back, or the dollar amount you're going to get back from the charity every year is. So you can do the math and figure out what the sweet spot is there, what works for you in terms of giving assets away and what you would like to keep in terms of an income stream. You get an income tax deduction for the portion that's going to the charity. And this type of a gift is called a split gift, because if you think about it, there are kind of two different transfers going on. The asset is going to the charity. It will be invested and you get the income from it for your lifetime. So you're not going to get an income tax deduction for the entire amount that you've transferred under this contract, because you're keeping some of it for yourself. So there's an actuarial calculation that's done based on assumptions that the IRS publishes and you have to use to figure out what your income tax deduction for that piece that eventually stays with the charity is going to be. And so it's kind of a math problem that you can work out with your accountant to figure out if the income tax deduction works, the annuity coming back to you works, the assets that are going out of your hands to the charity all works. Let's see. Like I said, you get the fixed income stream for your lifetime. And if you can do this with cash, obviously, but if you're gifting appreciated assets, appreciated stock, again, you're not going to eliminate the tax on those because you're keeping a portion of these assets in the form of the income stream, but you can spread that tax out over the life of the annuity. So it's kind of a nice income tax deferral mechanism in circumstances where that makes sense. Disadvantages of this, it is, again, an irrevocable gift. Once it's done, you can't undo it. It's not good for really complicated types of assets, cash and marketable securities, which are really what most people probably work best. And if you have a situation where you've got two annuitants, it's not just you're making a gift both to the charity and the other annuitant, it just makes it a little bit more complicated, but not certainly not something that's undoable. And this is, a lot of charities offer these, and they're very well versed in them and can explain how they work at their particular organization. The last technique I want to talk about is the most complicated thing we've talked about so far, and this is a charitable remainder trust. And this is a little bit of a tool for a specific kind of problem you're trying to solve. It's a little bit like the charitable gift annuity, except it's not a contract with a charity. This is a structure that you set up. It's a trust. You set it up yourself. You put assets in it. Those are devoted to charity at the end of your lifetime or a term of years. And during that term, you keep back a stream of income. Why would you do this, you might ask? And the reason we see people do this, or there are a couple of reasons. Number one, it gets assets out of somebody's estate if they're worried about estate taxes, but it allows them to keep the income from the asset. So if they don't need the asset itself, they're not going to sell it, but they'd like the income, it works well. And it also works really well for people. If you think about a Silicon Valley person who started a company and that company is now public and all their wealth is tied up in that single stock, and they'd like to diversify their holdings because they have a ton of risk if they own just one asset. But if they sell that stock, they're going to pay a huge amount of tax. This is the problem that the charitable remainder trust solves really well. And the reason for that is when you put that asset in the charitable remainder trust, it is a charitable entity. So it can sell that stock, diversify the holdings, and not pay any income tax on that sale. So right there is a huge advantage. Then, like I said, you keep the income over the life of the trust, either as a percentage of the initial investment in the trust or a percentage of the value of the trust every year. And when you get that income stream every year, you're going to pay tax on it. But what you've done is you've deferred that tax on the sale of your stock. You're not taking it all in a single year. You're spreading it out over time. And the way it's taxed is a lot more complicated than just, if you have a 10-year trust, it's not a tenth of the tax every year. It's under kind of a convoluted tier structure, and some of it's capital gains tax, which is at a lower rate, and some of it might be ordinary income tax, which is at a higher rate. But it can be a very effective technique when you need to diversify assets. And that's why we see this used a fair amount. But it's more complicated. It works well for that particular problem. It works well for much larger gifts than some of these other techniques because it does require the attorney to draft it. It might require appraisals. An accountant needs to be involved. There's a lot of monitoring that needs to go on with this. So it doesn't really make sense unless you have a large dollar at stake, a large dollar amount at stake here. And that is what I already said. This slide, I think, is just kind of interesting because it reminds us that there are a lot of different types of assets that can be gifted. It's not just cash. And, you may think I have a really simple situation, I have my checking account and my little stock portfolio, but look at all these different kinds of things that can be used for charitable gifts. And again, the one that's kind of, the hot topic of the moment is the cryptocurrency, because people are trying to figure out what to do with that, which is not necessarily intuitive. So I am at about 32 minutes here, and I am mindful of the time. So hopefully that's given us a little bit of an overview of the landscape of charitable giving. I'm happy to answer questions. I can only see my presentation because I do not have the skill set to do anything other than look at the presentation. And I'm afraid if I hit any sort of button, that's going to shut this entire production down. So I don't want to do that. But Kate, I can see you. And if there are any questions, I'm happy to take them. And now I think I can stop sharing maybe.
There you go. You did it.
Wow, that is I'm really happy that happened and we didn't shut the whole thing down.
Well done. Well, thank you. There's so much there, but what great information. and very well explained. Much appreciated. So we'd love to hear if there's any questions out there. If you want to throw it in the chat, or if you don't know how to chat, you can go ahead and unmute. No questions at all.
Well, the good news is we're going to put the recording of your fascinating presentation. Denise, I learned all kinds of things. I was just so interesting and so well presented. Thank you so much.
Thank you. You're very kind.
Totally true. We will
Oh,
put.
there's one question.
Oh, okay.
Alan says, are you seeing people changing their will?
Oh, yeah. Okay.
Yeah.
So we do have a question. Yeah. Can you see that? Are you seeing people changing their wills?
Oh, yes, I do. Yeah, I do. Yes, actually, yeah, a lot of people. The pandemic has really hit home for a lot of people, and I would say the vast majority of the clients that I work with here at Northern Trust are pulling out their estate plans and looking at them and really thinking through, is this really what I want to do, on a lot of different fronts. Because I think, you know, when you do your planning, you're doing it by and large when you're healthy and you're young and there's nothing imminent, and it's hard to make that real sometimes. And when you're facing a pandemic and you see all this horrible death and suffering, it becomes much more real. And while that's awful, it does put things in a different light for people, and they really tend to think through, do I want to actually do this? Either in terms of, you know, who I'm giving what to, or who's in charge, or when people get things, or you know, who's going to take care of my kids if something happens to me. So it's been a very busy estate planning time, which I think in some ways is good, because it really gets people to think about, to be very thoughtful about what they're doing. And I will just add to that, we do see a lot of gifts being made to charitable organizations, which always makes me really happy.
Great.
Thank you so much for that amazing presentation. And only what would happen at WildCare, I'm going to jump off because we found a sick rat in our backyard, and I'm going to jump in the car because I've been coming from home and bring it.
Oh, no.
So if anybody's there, tell Melanie I'm on my way back to the office.
Absolutely.
Yeah. So thank you, Denise, so much. Hopefully we maybe have a couple more questions, but that was amazing. And yeah, that's a lot of information. Incredible.
Thanks, Ellen. Good luck with with your transport. That's an excellent pitch for WildCare right there.
Yes, it is.
Absolutely.
We take rats.
Take rats and squirrels. We had
Yeah,
we had an injured squirrel in our yard a couple of years ago, and of course I called Kate. What do I do with the squirrel?
Right.
Well,
That's wonderful.
They don't need no more squirrels, but we'll take them anyway.
Exactly. I was going to say, so this recording will be on our website. We'll send an email to everyone after the event, so you'll have access to the website that has the recording, so you can watch it again. And I'm going to definitely have to do that because there was so much information in here. Thank you again. And we will also, if you have questions, we'll have an email, and you'll be able to send those questions, and we can get those to Denise, and she can get those answered for you. So that would be that'll certainly be easy to do. So if you don't have anything that comes to mind immediately, Kate, what else do you have to add?
I believe you covered it. And I don't know if we want to share the deck or not, but I think we'll just share the recording. If somebody asks otherwise, we'll get the deck out as well.
Oh yeah, Rachel.
Oh yeah, I'm happy to share that if anyone really has nothing else to read, happy to share it.
My question really is my life has changed a lot in the past 3 years, and I have no will whatsoever. And I do have assets, and I don't even know where to start. I don't know what to do. I don't know who to call, help, Ghostbusters. No, I don't know.
Ghostbusters. Yeah, there you go. Well, so you need a will. That goes without saying.
Right.
And you need to get to a competent estate planning attorney that I think for somebody in your situation where you don't know where to start and you haven't gone through this before, competence is obvious. You need somebody that knows what they're doing. But I think the estate planning attorney really needs to be a good personal fit, because you're talking about really difficult personal details. And I can't tell you the number of times that I've helped clients move from one attorney to a different attorney just because it wasn't a good fit. Or there might have been a situation where we've recommended 3 attorneys that we've worked with and we think their work is good and we think that would get along with our client, but the click just isn't there. And so the one piece of advice I would give you is make sure you have a good personal connection with this person, because this person needs to help guide you through some really difficult decisions. And you can reach out to, I'm happy to give you recommendations in I assume you live in Marin, in the Marin area, people that we've worked with. You can ask friends. If you have an accountant, just get some names from people. Okay. And interview people, interview 2 or 3 people and see if you like them, because you really need to like this person. Or I think what happens if you don't like this person, you're not going to get your plan done. You just won't do it, because it's not a comfortable situation to be in. So that's my 2 cents.
Perfect. Thank you so much. I really appreciate that.
Sure.
I wanted to jump in as well. Rachel, your situation sounds a little more complicated with assets, but WildCare does have the free will tool on our website, which is kind of a really good way to get started with kind of, again, I think you'll want the advice of an attorney, but the free will tool. So if you go to, I think it's discoverwildcare.org/free will, but I will put the link in the email for you. And that will take you to the page. And for someone like me that my finances are pretty simple, walking through that tool and just creating a simple will for myself felt like a really easy way to start. So, Denise, I think that Rachel probably does have a different situation, but for people in my situation, the free will tool was very, very user-friendly.
Well, you made a good point, though, because the nice thing about that kind of a tool is it will get you thinking. Mm-hmm. You print that out and you have to write down the answers to the questions. That means you have to think about it. So it gives you a starting point. So when you go into your attorney, whoever you end up wanting to work with, you have an idea of kind of what you want to do, mm-hmm. or where you may want to go, which is a much easier discussion than, oh my gosh, I have no idea what to do. What should I do?
Right, exactly. I didn't even know what to ask you now, so that would be helpful.
Yeah, so it will focus you a little bit more, and I think that's always helpful.
Good idea.
If that shortcut doesn't work immediately, as soon as I'm off this call, I'm going to go make that shortcut on the website. So discoverwildcare.org/free will, all one word, and that will go to the page that has that link and that information if you want to check that out.
Okay, I will. Thank you.
Remind me to do that. Yeah. All right. Awesome. Well, if we don't have any other questions, again, we will have the ability to send emailed questions if you have them. And I think we'll probably sign off for the evening. We're coming right down to time. It has been such a pleasure, Denise. Thank you so much for sharing your incredible knowledge, your expertise. Kate, you as well, my dear, so wonderful. So glad everyone could join us. What a fun evening this was. I hope you enjoyed the format. Doing Zoom webinars and meetings is something that's pretty new for WildCare, but it's really pretty fun for us too. And so keep an eye on your email and on our social media for other events that are coming up with hopefully interesting and informative topics for you. So thank you so much. Visit us online, discoverwildcare.org, and we will hopefully talk with everyone soon. Thank you.
Thank you.
Thanks, everybody. Good night.
Bye-bye.